Thanks for taking the time to meet with me there, Paul.
Of
Very
course.
excited to learn more. Yeah, to learn more about your business. You know what? One of the things that always just sort of keeps coming up is I hear like everybody's concerned, like, should they pick a fixed or a variable rate mortgage? How do you help your customers make this decision?
Great question. And a lot of it does depend on what gives you a good night's sleep. That is to say, are you okay with fluctuations, or do you want the set and forget me, which is usually the fixed rate? So first of all, how do they work? With a fixed rate, it is exactly how it seems and how it sounds. If you get a 5-year fixed rate, then let's say you lock it in today's rate, the best you'll get is 4.24. So you lock that in, and for 5 years, the monthly payments will be the exact same. This assumes you're not paying it off early. If you do, some lenders will automatically adjust your payments, while some will not, but you end up paying, of course, less interest, more principal. There's different ways to do it. And actually, I should take a step back. It really depends on whether your strategy is to save on interest or save on cash flow. Those aren't the same thing. And I'll talk about that actually more when I speak to 25 or 30-year amortizations. But just on the fixed or variable side, you pay the same amount every month, or bi-weekly or weekly. You can have different payment terms, of course. And that's it. And about 3/4 of Canadians have traditionally chosen fixed because of the quote unquote peace of mind that you know exactly what you're paying every month, right? Now, the downside of a fixed rate, and some of the upsides, of course, too, is that right now in this moment in time, fixed rates are a little bit lower than variable rate. However, you'll see in a second why that's not what history says in terms of what has been generally lower. The downside on fixed is exactly what it sounds like, is that because it is fixed, you cannot change it. So 4.24 sounds amazing now. Talk to me in 6 months to a year. That may not look so hot when rates are now in the the low 4s, high 3s, mid 3s even, right? So you can't really capitalize off it when rates go down. Of course, if you were part of the lucky few that locked in a fix at 1.69 in 2021, while variable was 0.99 in some cases, and now, of course, variable shot up to as high as 6.5 for some people, you're laughing. But again, it depends how you time it, and it's very hard to time rates, and it's very hard to time real estate prices. The old saying goes, it's not about timing the market, it's about time in the market. So do you have the long-term strategy for it? So that's fixed. And I should say, if you break the mortgage because you want to go for a lower rate, or there's a divorce, or you sell your house, or you're downsizing, or there's about 4 or 5 different levers that actually make you break your mortgage. Sometimes moving out of province, actually, if you're a credit union, then you are subject to a pretty big mortgage penalty. Just for easy math, take your mortgage, and it could be 1%, it could be 3%, it could be 5%. So so we have literally had clients who tried to move from, let's say, CIBC, and they had a $120,000 potential breakage penalty. This is on, mind you, over $1 million mortgage, but 10% of your mortgage. Can you imagine paying that? That's almost like paying the foreign buyer's tax. Well, I guess that'd be half of it. So you're basically locked in. And again, if you want to be versatile and you have lots of move in your life, and or you want to move your capital strategically as an investor, fixed has a lot of risks, right? Variable, why people don't like it, and usually why it's generally been 1/4 of folks who have chosen it, is because it can vary. So, Bank of Canada meets about every 6 weeks, and, the last 2 months, they've lowered it by 0.25 every time. Between 2021 and, 2023, it went up almost 5%, right? So usually will increase or decrease by 0.25 to 0.5. And with variable, you will either gain from that or you will lose from that. And if you were back to that story of locking in at getting a 0.99 variable, that variable ended up being 5-ish%, right? So it was pretty painful for a lot of buyers. Now I'm going to go back to the strategy of, are you optimizing for minimum payments per month and or predictability in payments per month, or saving on interest charges over time? The latter is more what an investor will look at, and really anyone who's business minded or really looks at the numbers. The former might be more people that they don't care about optimizing their finance necessarily. They just want to make sure that the payments stay low because they're tight on budget. And so with a variable mortgage, if the rates, go up, for example, there's a rule of thumb on a $500,000 mortgage. If it goes up, the rates go up at 0.25, then they say your monthly payments will go up by about $26 a month, right? That's kind of a general rule of thumb, and there's ways to run the math on that with any calculator. So is that the end of the world? No, but when you compound that, for example, when it went up by 5%, right, was $26 times, in this case, that would be times 20, right? So it ended up being quite a bit, right? Some people had over $1,000, sometimes even $2,000. If you had a big mortgage, $3,000 more that you're paying. So that was a problem. Something that is less known is basically between a fixed and a variable. In the industry, it's just called a variable rate mortgage, or a variable fixed or variable capped rate mortgage. What that means is that when rates were going up, people kept paying the same amount per month. So you think about, wait a sec, but there's variability. How does that work? The way it works is that what they will do, again, if you're able to save on cash flow, and even if you are in a market where rates might go up, if you work with TD, for example, it's a fixed variable rate mortgage. So rates started to go up, you pay now, let's say, $26 more per month. But if your payments stay static, then what's happening? Well, remember, a mortgage payment is principal and interest, right? Interest is throwaway money, as if you're paying rent, and principal is you're paying into your equity. You're actually owning your home more. So out of those $26, you're still paying $26 more per month, but that means you're paying $26 less of principal, $26 more of interest. So effectively, you're worse off by $26 is the point, right? But if you care about cash flow and you're not in a rush to own your house outright, I mean, we all kind of are, but if that's not a thing that would change your life, then you're still paying the same amount per month. You still have variability, and you still can take some of the benefits of it, right? That's a big thing that people don't realize. If you work with someone like Scotiabank, they have an adjustable variable rate mortgage, which is exactly how it sounds, is that if, the second it goes up 0.25 or 0.5, you're now, paying another $26 per month, or 52 if it's 0.5, right? You can do the math on it. So that's variable rate. And I did allude to this at the beginning of the question, is the actual historical data on variable rates and versus fixed rate is that variable wins by a landslide. Right? Now, we of course like to fall victim to the recency effect, being that, recently people that got variable rates were very unhappy, right? So of course, we've seen a lot of 3-year fixed and even 5-year fixed. People are spooked, I get it. But you really have to look at the full picture. If you're a hockey fan, sometimes or any kind of sports fan, you'll look at the champions from the last 25, 30 years, right? And, if you like hockey, you'll see some of the dominance that the Red Wings had at some point, the Canadians. It's just kind of fun to go back and watch. I found a chart around variable versus fixed, and it would say it'd say what the average rate was that year, and then the winner of the year. And I felt like, the Montreal Canadiens were sponsored by variable rates, because once I looked at the chart, the way the stats are, and maybe you can take a second to guess, from 1975 to 2024, how many times do you think the fixed rate on average was lower than the variable? The answer is 6 times. They only won 6 championships, 48 years. So what does that mean? Talk to a broker when you're just being strategic on weighing your options, shopping for rates, beginning education. And of course, if you go the bank or the broker route, at least on the A side of lenders, and you see you can't qualify, okay, what's plan B? What's plan C? And that's where brokers are exclusively going to be your option for B and C lending, because you cannot get that by yourself.
No, that's great. That's a great way to finish. I like that.